Now 2022 was a rough year as expected, and unfortunately 2023 will not be any better. In this video, I will share with you my expectations moving into 2023 and why I believe it is a good year to accumulate more investments despite the pain that is expected in both the markets and the economy. Without further ado, let's get started with the 3 central themes that is expected to play out next year. Number 1. Central bank induced recession. The first theme that I would like to talk about is the topic on recession. Moving into 2023, it is almost certain that the global economy will enter into a recession that is induced by the central banks tightening in an effort to combat against inflation. So for those who have not been keeping up with the developments this year, essentially what happened was that the prices of the goods and services had skyrocketed, with some countries experiencing a double-digit inflation rates. In response, governments all over the world have stepped in to combat against unsustainable rise in prices via higher interest rates. Now, higher interest rates will bring about higher borrowing costs for both businesses and consumers, which then drives down economic activities as business net earnings and consumer saving rates are negatively affected. The problem today is the fear that the central banks would over-tighten and increase their interest rates too much, which then ends up driving the global economy into a recession. In fact, over 3/4 of the economists surveyed said that the risk is tilted to an over-tightening scenario, and over 80% of them expects a recession to occur moving in the next 24 months. Unlike previous recession, however, if indeed a recession materializes next year, do not expect the central banks or the government to step in to resolve the recession, as this very recession that we may be experiencing is one that is intended by design. The purpose of inducing this recession is to slow down demand and get inflation back in control, as it is unlikely that the supply side constraint can be resolved to alleviate the current inflation situation. Now, this is especially so for developed countries as they face production constraints that are driven by immovable trends such as lower labour participation rate, aging population, and deglobalization, which inevitably pushes up costs, which then gets transferred to consumers via higher prices. Now, the only time when the central banks and the government may step in is if number 1, the unemployment rate increases beyond what was expected, number 2, economic activity deteriorates further than what was intended, and number 3, inflation rate comes back down to the Federal Reserve 2% target. So far, this does not look like it's going to happen anytime soon, as employment rates is still strong. The economic activity, while deteriorating, is still healthy, and on the topic of inflation, it is unlikely that it is going to come back down to 2% anytime soon, especially with China's reopening, which brings me to my next topic. Number 2, China's reopening. The second big theme of 2023 is China's gradual reopening and move away from the COVID-0 stance. While China's reopening is one that is highly rejoiced, with most economists forecasting a full exit by March next year, the road of reopening will be one bumpy ride ahead, as China will have to battle with rising COVID cases, death counts, and a strained healthcare system. Furthermore, given the constant Chinese propaganda on COVID-19 over the past 3 years, it is unlikely that China's economic activity will resume back to pre-COVID levels immediately after the government had exited from their COVID-0 policies, as even in the absence of restrictions, people have voluntarily stayed at home. That said, given how beaten up China's economy is, it is safe to say that China's recovery will be highly likely, as they are starting from a very low point. Now, what is absolutely necessary is for the CCP to take actions that will revive its consumer, businesses, and investors' confidence. Once that happens, it will greatly increase the efficacy of the current policy stimulus, thereby prompting economic growth to accelerate further. On one end, China's reopening is good news for investors in Asia, as it could provide some fresh momentum in Asia's demand, especially at a time when US and EU economy are slowing down. On the other hand, China's reopening is expected to contribute to higher inflation rates, as the pent-up demand in China will compete for a limited number of goods around the world, thereby keeping prices at an elevated level. At the moment, Chinese households are holding a total of $116.5 trillion in deposit account, which is 42% higher than the pre-COVID-19 level. Should this demand be released as the economy reopens, the spillover effect to other Asian economies will be a welcome source of growth, while the higher prices will be a nightmare for economies combating high inflation rates, especially for those in the West. Number 3. Higher for longer. The third big theme of 2023 is the behavior of the inflation rates and interest rates, which are expected to persist at a higher levels for a longer duration. On the topic of inflation, while inflation rates have indeed started to trend down based on the figures, I foresee inflation rates to remain at higher levels for a longer duration as firstly, with China's reopening that is set to happen, I believe that the gradual return of Chinese consumer will prop up prices, which will offset the slowdown in demand as a result of a possible recession. Secondly, based on historical data, inflation rate across advanced economies have taken an average of 5 years to return to 2% once it breaks above 5%. Inflation will likely take longer, or rather much longer than expected, to moderate. On the topic of interest rates, based on the Federal Reserve stance, interest rates are expected to peak around March but stay higher for almost the entirety of the year before coming back down in 2024. And looking at how the inflation situation would be, I believe that the current forecast of interest rates behavior is likely to materialize. Implications to us investors. Looking at the current market valuations and what is expected to come, I believe that the market has more room to fall as the market has yet to price in the impact that a recession will do to earnings of businesses. On the developed market side, which will be represented by the S&P 500, valuations today are still trading at an elevated level as compared to the long-term average. And what this means is that even without an earnings revision, there is more room for prices to come back down for valuations to go back to normal levels. Now, even if valuations were to remain elevated, for us to maintain the valuations that we are experiencing today while having a low and lower earnings figure, prices will have to come down, which builds on the case as to why there are more pain to come for the general markets, as a drop in the US market will inevitably spill over to other parts of the world. That said, the risk of a structural failure like that of a 2008 financial crisis in the US is low, as the US currently have a healthy balance sheets for both the household and corporate sector, which was helped by the deleveraging efforts since the global financial crisis and fiscal packages in 2020 and 2021. On the developing market sides, which will be represented by the Asian equities, valuations are currently trading below the long-term average, and as such, it presents an opportunity to participate in the growth of these developing countries at a discount. That said, while valuations may be cheap and while the tailwind of China reopening will give the developing markets a boost, the high correlation of the developing markets with the US markets may result in further drop in Asian equity prices despite it being undervalued. I went through the financial modeling and fundamental analysis of the expected annual rate of return for both the US and Asian equity in my 2022 portfolio update video, so please go and check that out if you are still curious about the fundamental analysis side of things. Actions to be taken. As investors, there is no better time to accumulate our investments when the prices are falling at the back of fear and pessimism. Should the global economy enter into a recession, it will be a pivotal moment for the markets as the mindset of investors, businesses, and consumers will shift from battling the uncertainty of whether a recession would occur to anticipating the economic recovery that is bound to happen. Now, most of the time, stocks will bottom about 6 months before the economy, and the early recovery phase of an economic cycle is one that typically presents the strongest return prospect based on market history. That being said, we should embrace the pain that is bound to happen in 2023 and accumulate as much discounted investments as possible to position ourselves for the eventual recovery. The next 18 to 24 months will be a rough time for the markets as prices will remain depressive, but as long as we can get through this period, which we will eventually, we will look back at this episode as a plausible opportunity of the next decade. Now, that's all I have for this video today. If you do not know how to get started with your investments, or if you do not have the time to manage your investments, you can check out what I do on my website to see how you can benefit from my investment planning services and reach out to me directly. Subscribe to this channel or follow me on Telegram or Instagram to receive a 1-minute daily market update and stay updated with the weekly upload. Good luck in 2023 and I hope to hear from you soon.